Following your bank's advice could cost you over $300,000 in your lifetime. Mark Cuban fired his financial advisors after realizing they were costing him millions. His exact words, "I was paying him to lose my money slower than I could do it myself. I spent 8 years as a financial advisor before. I couldn't take it anymore. I'm about to expose 10 lies that banks tell you every single day, and some of the world's wealthiest people built their fortunes doing the exact opposite of what banks recommend. If you want to stop being a profit center for banks and start building real wealth, let's dive in. You need perfect credit to build wealth. The first lie banks tell you is that you need perfect credit to build wealth. Let me ask you something. What's more important, having a perfect credit score or having $1 million in the bank? Banks will tell you that credit is everything. And why wouldn't they? Credit products generate massive profits through interest, fees, and keeping you dependent on their system for decades. But here's what they don't want you to know. Credit scores measure how attractive you are as a borrower, not how wealthy you can become. Think about this for a second. The credit system was designed in 1989 to predict loan defaults, not measure financial intelligence. It actually rewards people who consistently borrow money and penalizes those who pay off debts too quickly. Here's a story that will blow your mind. Dave Ramsey had everything banks said he needed in his 20s. Perfect credit scores, multiple credit lines, $4 million in real estate. He was the model customer every bank wanted. Then 1988 happened. Banks changed their policies overnight and called in his short-term notes. Despite perfect credit and following all the rules, Dave lost everything and filed bankruptcy at 26. Here's the kicker. After rebuilding from zero, Dave deliberately chose never to use credit again. He built his company to over $200 million in value using only cash. His net worth today? Higher than what he lost. And this time, it can't be called in by any bank. Comment below. Are you prioritizing your credit score over actually building wealth? I want to hear your thoughts. The truth is, credit should serve your wealth-building strategy, not define it. The wealthiest people focus on creating value and accumulating assets, not optimizing their borrowing capacity. Savings accounts are your financial foundation. The second massive lie is that savings accounts are your financial foundation. This one fires me up because it's destroying wealth in plain sight, and people think they're being responsible. Banks love your savings account because it gives them cheap money to lend out at much higher rates. Meanwhile, you're literally getting poorer every single day. Here's the math that'll shock you. Right now, most savings accounts pay 0.5%. Inflation averages 3 to 4% annually. That means your money loses purchasing power every single year. Let's say you have $50,000 in savings, earning 0.5%. After 5 years, you'll have $51,253. Sounds safe, right? Wrong. With 3% inflation, you'd need $57,963 to buy the same stuff. Your safe account just cost you $67,010 in wealth. Ray Dalio, who built the world's largest hedge fund, calls cash trash in inflationary environments. But here's what he actually does. And this is what banks don't want you to know. Dalio keeps 3 to 6 months of expenses in high-yield accounts, then puts the rest in Treasury I-bonds, money market funds yielding 4 to 5%, and short-term Treasury bills that actually protect purchasing power. Think about this. Every dollar in a 0.5% savings account, instead of earning 8% market returns, costs you massive wealth. Over 20 years, $10,000 at 0.5% becomes $11,051. The same money at 8% becomes $46,610. That's $35,559 in lost wealth from being too safe. Quick question for you. How much money do you have sitting in low-yield savings right now? Drop a number in the comments, even if it's 0. No judgment here. There's good debt versus bad debt. The third lie that keeps you trapped is the idea that there's good debt versus bad debt. Banks love this myth because it keeps you borrowing forever. They'll tell you student loans are good debt, mortgages are good debt, business loans are good debt. But here's what they never tell you. All debt creates obligations you must meet regardless of circumstances. Let me tell you about Robert Kiyosaki's shocking revelation. The Rich Dad, Poor Dad author discovered this lesson the hard way during his first business venture. Kiyosaki started a rock and roll product company in the 1970s that was generating solid revenue and growing rapidly. Everything looked perfect on paper. He had what banks considered good debt, business loans secured by inventory and receivables, lines of credit for growth capital, all backed by a profitable company. Then his main distributor went bankrupt overnight, owing his company hundreds of thousands in receivables. Suddenly, his good debt, backed by safe business assets, became a nightmare. Banks didn't care about his circumstances. The debt had to be paid regardless. This experience taught Kiyosaki that debt doesn't care about your situation, your excuses, or your good intentions. It must be paid no matter what happens to the underlying assets or income streams. After rebuilding, Kiyosaki focused on generating multiple income streams and acquiring cash-flowing assets before taking on any debt. When he did use leverage later, he structured it with multiple exit strategies and conservative ratios. Here's what successful investors actually do. They evaluate risk-adjusted returns, not just gross returns. They maintain conservative debt ratios even with good debt. They prioritize cash flow over leverage multiplication. They always have multiple exit strategies before borrowing. Let me know in the comments. Have you ever been sold on good debt that turned out to be not so good? Banks are essential business partners. The fourth lie that keeps entrepreneurs dependent is that banks are essential business partners. This myth slows business growth and keeps you dependent. Banks want you to believe you need them for credibility, growth capital, and operations. But many of today's biggest success stories were built with minimal bank involvement, and this story proves it perfectly. In 1992, Daymond John borrowed $40 from his mother to start making hats. Banks wouldn't even look at him. No credit history, no collateral, no chance. Instead of seeing this as a problem, Daymond focused on what he could control. He converted half his mother's house into a factory, worked other jobs to fund operations, and reinvested every profit dollar. FUBU grew through direct sales, word of mouth, and strategic partnerships, not bank financing. When they eventually needed capital, they had built enough revenue and brand value to attract investors on their terms. The result? $350 million in annual revenue, and Daymond's net worth exceeding $350 million, all while maintaining control over strategic decisions. Here's the strategic approach successful entrepreneurs actually use. Use banks for basic operational services only. Focus on revenue generation over credit relationships. Build cash reserves through profitable operations. Consider alternative financing when needed. Maintain professional banking relationships without dependency. Business owners in the comments, have you ever been told you need a bank relationship to succeed? Share your experience. Financial advisors work for your interests. The fifth lie hits close to home because I lived it, that financial advisors work for your interests. The financial services industry generates enormous fees without delivering returns that justify their costs, and this should fire you up. Here's the math that should shock you. A typical advisor charges 1 to 2% annually. Seems small, right? Over 30 years, these fees consume 20 to 40% of your potential returns due to compound growth. Let's break this down. $100,000 invested for 30 years at 8% returns. Without fees, $1,006,265 final value. With 1.5% annual fees, $661,437 final value. Total fee cost, $344,828. That's over a third of your wealth transferred to professionals who statistically don't beat simple market indexes. Warren Buffett proved this with his famous $1 million bet. He wagered that a simple S&P 500 index fund would outperform hedge funds over 10 years. The results? The index fund grew $1 million to $1,854,000. The hedge funds averaged only $1,220,000. The simple index fund generated $634,000 more wealth than sophisticated professional management. Buffett donated his winnings to charity, but the lesson was clear. Fees compound against you while returns compound for you. When does professional help actually make sense? Complex estate planning requiring legal expertise, specialized investment areas requiring deep knowledge, behavioral coaching for emotional investors. Comment below. Are you paying management fees right now? Do you know exactly what you're paying and what you're getting for it? Home equity is smart leverage. The sixth dangerous lie is that home equity is smart leverage. Banks love promoting home equity loans because they get to use your house as collateral while you take all the risk, and this should fire you up. Here's what they don't emphasize. Your home secures the debt, creating foreclosure risk. Real estate and stock markets often crash together. Variable rates can explode your payments overnight. From 2003 to 2007, banks aggressively promoted home equity borrowing as both real estate and stocks climbed. Millions extracted equity for investments, debt consolidation, even vacations. Robert Shiller, Nobel Prize-winning economist, saw what was coming. He wasn't some Wall Street speculator. He literally created the Case-Shiller Home Price Index that tracks housing prices. Years before the crash, Shiller warned that home prices were rising far faster than fundamentals could support. He called out the speculative mania, while Fed Chair Alan Greenspan denied bubble risk. What happened next? Families who followed banking advice and borrowed against their homes got destroyed. When the bubble burst in 2008, home prices collapsed in the largest drop in Case-Shiller Index history. Foreclosures skyrocketed as mortgages reset to higher rates. People lost their homes despite making sound decisions based on prevailing financial advice. The key insight: treat your home as shelter. First, investment second. Never risk your family's housing security for investment speculation. Drop a comment. Did anyone in your family lose their home during 2008? This stuff has real consequences for real people. Certificates of deposit are safe investments. The seventh lie disguised as safety is that certificates of deposit are safe investments. This safety is costing you thousands while banks profit from your deposits, and it should fire you up. Yes, CDs are FDIC insured against bank failure, but they often fail to preserve purchasing power due to inflation, making them wealth destroyers disguised as safe investments. Here's the reality check. CD rates typically run 1 to 3%. Historical inflation averages 3 to 4%. Your money loses real purchasing power despite guaranteed returns. Let's do the math. $50,000 in a 5-year CD earning 2% annually. After 5 years, $55,204 nominal value. With 3.5% inflation, equivalent purchasing power equals $47,144 in today's dollars. Actual wealth loss: $2,856. You got a guaranteed return while becoming definitively poorer in terms of what your money can actually buy. George Roche managed the T. Rowe Price New Era Fund starting in 1969 and thrived during the 1970s inflation crisis. How? He focused on companies producing essential goods, energy, natural resources, basic materials. While cash and CDs lost purchasing power, Roche's fund grew substantially by investing in firms providing what people actually needed. The lesson: safe investments that don't beat inflation guarantee wealth destruction over time. True safety means preserving and growing purchasing power, not just principal. Question for you: how much money do you have in CDS right now thinking it's safe? Let me know in the comments. Car payments are normal and necessary. The eighth and final lie that keeps millions poor is that car payments are normal and necessary. This myth keeps families from building substantial wealth by normalizing permanent car payments as standard American life. And this should absolutely fire you up. The opportunity cost will shock you. Average new car payment: $563 per month. Average used car payment: $397 per month. If $500 per month invested at 8% over 30 years, $679,516. That's the real cost of perpetual car payments. not just the cars, but the massive wealth that could have been built instead. Warren Buffett, worth over $100 billion, famously drove a 2001 Lincoln Town Car until 2014. 13 years of reliable transportation from one purchase. When asked about his modest car choices, Buffett explained, "The car gets me from point A to point B. Anything beyond that is consumption, not investment. I'd rather have that money earning returns in productive businesses." Buffett understood this principle. Every dollar spent on unnecessary automotive luxury represents dollars not compounding in wealth-building investments. When might automotive financing make sense? Business vehicles generating income exceeding all costs. Ultra-low interested financing at 0 to 2% where cash can earn higher guaranteed returns. Strategic credit building paid off quickly. Here's my challenge for you. Calculate what your car payments could be worth if invested instead. Share that number in the comments. It might shock you. You need a big emergency fund in the bank. The ninth lie that keeps your money trapped is that you need a massive emergency fund sitting in the bank. And this one fires me up because it's disguised as responsible advice. Banks love telling you to keep 6 to 12 months of expenses in savings accounts. Why? Because it gives them massive amounts of cheap capital to lend out while paying you practically nothing. But here's what they don't tell you. Most emergencies aren't actually emergencies. They're predictable expenses you haven't planned for properly. Ramit Sethi tracked his clients' emergency fund usage over 5 years and found something shocking. 85% of withdrawals weren't for true emergencies like job loss or medical crises. They were for car repairs, appliance replacements, or annual expenses like insurance premiums. These aren't emergencies. They're predictable costs people simply haven't budgeted for properly. Here's what wealthy people actually do. They keep 3 to 4 months' expenses in high-yield accounts earning 4 to 5%, create separate sinking funds for predictable expenses, and invest the rest in liquid assets that actually grow wealth. The opportunity cost of oversaving is massive. If you have $40,000 in emergency savings, earning 0.5% instead of 8% in investments, that costs you $3,000 annually in lost returns. Over 10 years, that's $44,000 in wealth you've given up. Comment below. How many months of expenses do you have sitting in low-yield savings right now? I bet it's more than you actually need. Life insurance is an investment. The 10th and final lie that fires me up is that life insurance is a smart investment, and this one costs families more money than almost any other financial product. Banks and insurance companies push whole life, universal life, and variable life insurance as investment vehicles that provide both protection and wealth building. They'll show you projections that look impressive on paper. Here's what they don't emphasize. These products are loaded with fees that destroy your investment returns while providing overpriced insurance coverage. A typical whole life policy might cost you $4,000 annually. In the early years, almost all your premium goes to commissions, administrative fees, and insurance costs. The internal fees can range from 2 to 4% annually, crushing any potential returns. Suze Orman learned this when she started her career selling whole life insurance. After years of seeing the actual results, she realized clients who bought whole life consistently underperformed compared to those who bought term insurance and invested the difference. Now she calls permanent life insurance a very bad investment that primarily enriches insurance companies, not policyholders. The numbers are staggering. A 30-year-old might pay $4,000 annually for whole life insurance, but could get identical coverage with term life for $600 annually, then invest the remaining $3,400. Over 20 years, that $3,400 invested annually at 8% would grow to over $155,000. Meanwhile, the whole life policy's cash value might be worth $50,000 after fees. That's over $100,000 in lost wealth from choosing the investment option. Drop a comment. Are you currently paying for whole life insurance thinking it's building wealth? You might be shocked at what those premiums could be worth if invested properly. Look, I've shown you how these 10 banking myths could be costing you hundreds of thousands of dollars over your lifetime. The pattern I saw among truly wealthy clients was clear. They treated banks as service providers, not financial advisors. They minimized fees obsessively and focused on net returns. They educated themselves rather than outsourcing decisions. They made financial choices based on math, not marketing. The goal isn't avoiding banks entirely. That's impractical. The goal is using banking relationships strategically while keeping your wealth-building objectives as the primary consideration. Here's what I want you to do right now. Subscribe and hit that notification bell because I'm exposing more financial industry secrets every week that could save you thousands. Then comment below with which myth surprised you most. I read every single comment and I want to hear from you. Remember, your bank's success and your success aren't the same thing. It's time to start optimizing for your wealth instead of theirs.